studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
When planning compensation for a corporate owner-manager, many advisors immediately focus on the salary versus dividend decision. Since dividends usually avoid CPP contributions and reduce payroll administration, they are often viewed as the more tax-efficient option. However, there's one very important factor that can completely change that decision: child care expenses. Let's look at the family shown on this slide. Jessica owns a corporation and receives $60,000 of annual compensation. She and her husband have two young children, Jake and Nicole, and together they pay $11,000 each year in daycare expenses. At first glance, paying Jessica entirely through dividends might seem like the best strategy because it avoids CPP contributions. But once we consider the family's child care expenses, the analysis changes. The reason is explained on the right side of the slide. Under Canadian tax rules, child care expenses are generally claimed by the lower income spouse. But there is an important limitation. The deduction is restricted to 2/3 of that spouse's earned income. Notice the key words: earned income. Salary qualifies as earned income. Employment income qualifies as earned income, but dividends do not. Now look at the two compensation choices shown at the bottom of the slide. In the first option, Jessica receives all of her compensation as dividends. Because dividends are not earned income, her earned income for this purpose is effectively zero. As a result, even though the family actually paid $11,000 for child care, they may not be able to claim the deduction based on this rule. That can mean losing thousands of dollars in valuable tax savings. In the second option, Jessica receives at least part of her compensation as salary. That salary creates earned income, allowing the family to qualify for the child care deduction, provided the earned income is high enough to satisfy the 2/3 limitation. This illustrates one of the most important lessons in compensation planning. A strategy that looks tax efficient when viewed only from the corporation's perspective may actually produce a worse overall result for the family. Professional tax planning always looks beyond the business owner's personal tax return. It considers the entire household, family income, spouses, children, deductions, credits, and long-term financial goals all play a role in determining the best compensation strategy. That's why experienced tax advisors don't automatically recommend dividends simply because they reduce CPP contributions. Instead, they first ask questions about the client's family situation. Do they have young children? Are they paying daycare expenses? Which spouse has the lower income? Only after understanding those details can an advisor recommend the most tax-efficient mix of salary and dividends. In the next slide, we'll calculate exactly how much salary Jessica needs to receive in order to unlock the full child care deduction, while still keeping most of her compensation as dividends. In the previous slide, we learned that paying dividends alone can prevent a family from claiming valuable child care deductions, because dividends are not considered earned income. The obvious question now is, how much salary is actually required? The answer is shown at the top of the slide. Canadian tax rules limit the child care expense deduction to 2/3 of the lower income spouse's earned income. We can simply rearrange that formula to determine the minimum salary required. The calculation is straightforward. Take the total child care expenses and multiply them by 3. Then divide by 2. In Jessica's case, her family pays $11,000 each year for child care. Multiplying 11,000 by 3 and dividing by 2 gives us $16,500. That means Jessica needs at least $16,500 of salary in order to create enough earned income to support the full child care deduction. Now let's compare the two compensation structures shown in the middle of the slide. In the first scenario, Jessica receives her entire $60,000 as dividends. Since there is no salary, she has no earned income for this purpose. As a result, the family cannot claim the full child care deduction, even though they actually paid $11,000 for daycare. Now look at the revised compensation plan. Instead of changing Jessica's total compensation, we simply change its composition. She now receives $16,500 as salary and the remaining $43,500 as dividends. Notice that her total compensation remains exactly the same $60,000. The only difference is how that compensation is paid. This small adjustment produces several important tax benefits. First, the family can now claim the full $11,000 child care deduction because Jessica has sufficient earned income. Second, the corporation receives a deduction for the salary it pays, reducing its own taxable income. As illustrated on the slide, this corporate deduction can produce approximately $2,475 of corporate tax savings, assuming a 15% corporate tax rate. Of course, introducing salary also creates CPP contributions. Both Jessica and the corporation must contribute to CPP, creating a combined cost of approximately $1,287. At first glance, some business owners may focus only on that additional CPP cost and conclude that salary is a bad idea. But professional tax advisors look at the entire picture. By paying a relatively modest amount of CPP, the family unlocks an $11,000 child care deduction, while the corporation also benefits from a salary deduction. In many situations, the combined tax savings are substantially greater than the CPP cost itself. This is an excellent example of why tax planning should never focus on just one number. If we looked only at CPP contributions, dividends would appear to be the better choice. But once we include child care deductions and corporate tax savings, introducing a modest salary often produces a much better overall result for the family. This is exactly how experienced tax advisors think. Rather than trying to eliminate every payroll cost, they evaluate the combined effect on both the corporation and the family before making a recommendation. In the final slide of this section, we'll look at the planning process itself and see why these discussions need to happen before compensation is finalized. Asking the right questions early in the year can prevent valuable deductions from being lost later. We've now seen why introducing a modest salary can unlock valuable child care deductions. The final lesson in this section is about timing. Even the best compensation strategy can fail if the necessary planning isn't done early enough. The timeline at the top of the slide illustrates the ideal planning process. Everything begins with the initial client meeting. Before discussing salary or dividends, the tax advisor should ask whether the owner-manager has young children. If the answer is yes, the next step is to estimate the family's expected child care expenses for the year. Once those expenses are known, the advisor can calculate the minimum salary required using the 2/3 earned income rule. Only after that analysis is complete should the compensation package be finalized, T4 slips prepared, and dividends declared. Notice the warning at the end of the timeline. If dividends have already been declared and the compensation year has effectively been finalized, it may be too late to introduce the salary needed to support the child care deduction. At that point, the family could lose the deduction entirely for that year. This is why proactive planning is so important. The checklist in the middle of the slide summarizes the questions every tax advisor should ask owner-manager clients during annual compensation planning. Do you have children under the age of 16? Do you pay daycare or other qualifying child care expenses? Which spouse has the lower income? What is the estimated annual child care cost? And finally, based on that estimate, how much salary is required under the 2/3 rule? These questions may seem simple, but they can lead to thousands of dollars of tax savings when asked before compensation decisions are made. The slide also introduces a practical planning technique called the buffer strategy. Suppose the estimated child care expenses are $11,000, requiring a minimum salary of $16,500. Rather than paying exactly that amount, an advisor may recommend a salary of $20,000. Why? Because child care costs can change during the year. Extra daycare, summer programs, or unexpected expenses could increase the total deduction available. Paying a slightly higher salary creates a safety margin, ensuring there is still enough earned income if the family's actual child care expenses end up being higher than originally expected. The comparison table at the bottom reinforces the core principle we've learned throughout this section. A compensation package consisting entirely of dividends does not create earned income, so the child care deduction may not be available. By contrast, including salary creates earned income, allowing the family to qualify for the deduction, provided the earned income is sufficient under the tax rules. Finally, let's review the key takeaways. Child care deductions require earned income. Dividends do not create earned income. The 2/3 rule should always be used when determining the minimum salary required. Planning should take place before year-end, before T4 slips are prepared, and before dividends are finalized. Most importantly, compensation should always be customized to fit the client's family circumstances. This section highlights one of the defining characteristics of professional tax planning. The goal is not simply to minimize taxes inside the corporation. The goal is to optimize the overall tax position of the entire family. Sometimes paying a modest salary creates significantly greater tax savings than paying dividends alone. When advisors consider both the corporation and the family's personal tax situation together, they can often identify planning opportunities that would otherwise be missed. That's the mindset that separates a tax preparer who simply reports numbers from a tax advisor who creates lasting value for clients.